It's time again for Talking Trade, sponsored by MMAC's World Trade Association and Michael Best Strategies.
Hello, everyone. This is Talking Trade. My name is Ken Wasylik from EM Wasylik and Associates.
And I'm Sandi Siegel, president of ME Day, and it's a personal pleasure to introduce our guests for today. Bruce Glaub. Bruce, we've known each other for many, many years. Bruce is the principal of Trade Acceptance Group based here in Wisconsin, and certainly a long and diverse career in trade finance and global trade services. And we've crossed paths many times over the years with mutual customers, international banking issues. And, it's always a pleasure working with you, chatting with you on from the finance perspective of things. And it's really active in the local trade community. So I know you're, have your finger on the pulse of some of today's challenges going on with the economy and our importers and exporters. So welcome to Talking Trade. It's really nice to have you, Bruce.
Thank you. Great to be here.
Yeah, so Bruce, let's get started. And I know you're an expert in export credit insurance. Many companies don't use this. Why is it important for a company to have export credit insurance?
I appreciate the question, Ken. And let's start with a definition and we'll get into the benefits, because really understanding what it is kind of goes a long way. So really what trade credit insurance does, it protects your business. If your clients don't pay you, then the insurer is going to actually pay out a percentage of what you're not paid. So in the US, you have a lot of different choices and a lot of different ways to maybe collect your funds. Internationally, much more difficult. And you don't have that expertise in law. You just don't have the tools, or the tools are incredibly expensive. So rather than like what you do in the US, using the law maybe as your heavy hand, internationally, it's great to use trade credit insurance. That gives you the stick, per se, if you need to collect from someone. And then they are the ones that are in turn going to use the legal systems within each country. So you don't have to be the legal expert.
Sounds good.
So in this period of particular challenges on the important export side and supply chain in general, we've got shipments moving more slowly, unpredictably. I know we're getting vessels rolled all the time. Schedules are unpredictable at best. The currency, a strong dollar, which is not always in the best interest of exporters, and it impacts them, of course. Freight rates have risen, certainly over the last year or two. So a lot of economic and political challenge in today's environment. In addition to export credit insurance, what are some other tools that you take advantage of, utilize to be a partner, and advice you give your customers?
Yeah, so we'll go through some of the challenges and how our customers, the discussions we're having with them, and how they're maybe mitigating some of the risk. And we'll do it from a financial perspective. There are also other ways to be a really good partner with your customers. These are just some of the tools, the financial tools you can use. So in the supply chain, shipping, as you know, incredibly well, Sandy, that it's just taking longer to get from A to B. So the way trade credit insurance, the number one issue that we'll talk about, or tool we'll talk about, is it allows you to offer longer terms to your customer. So what that does is now, instead of, because they would be in essence paying for the product before it maybe even left port. In this case, they actually could, if you give them additional 30 or even 60 days, meaning net 90 instead of net 30. Now you're being a much better partner because they have the goods almost for sure, and maybe are even starting to sell some of them depending on what it is, or have it installed. The way it helps you is you now have, it's a longer term, but it's a protected term. So you have that guaranteed payment. So you know that, okay, I'm not going to get paid in 30 days, but I'm definitely going to get paid in 90. And if I don't, I have this insurance policy that's going to pay me if something catastrophic happens. But it's a good partner, so I probably won't have to use it. But it's that really is what a lot of our partners are doing, where they just extended terms, longer terms, just to show that good partnership. They'll probably bring them back in, as things get better.
Right. But it sounds like a win-win for, both the
Yeah.
parties involved. But terrific.
Right. And then what they can do, a lot of our customers that we work with are, they're pretty strong, so they aren't borrowing a lot, so they can wait to get paid. But we do have those that need that cash flow. So what they can do is they can add that insured receivable to their borrowing base. Their lender will happily lend against it, or they can even discount it to a factor. Those companies that are growing really fast and need every bit of capital, they can still act like a very strong company and just discount that. They don't make as much profit, but they still are a really good partner. And in these days, when you're a good partner, you both reduce the profit you're going to make in these tough times, so that then you both can win and gain market share for those good times. Kind of like, again, the key is that partnership piece.
Yeah, that's a great tool, Bruce, to look at right now. But right now, everybody's looking at headwinds on the economic side. I just got back from Europe, and they're talking about higher inflation. And here in the U.S., the recessionary winds are coming. We're talking about that here, slow growth in China and Asia. What are you telling your customers to do today to insulate them from the future over the next 6, 12, 18 months?
Great. Thanks, Ken. I'm going to take this in two parts. One, I want to give like an example for those that may listen and are in the capital goods space, because this is really critical and it's something they have not had to deal with for over 10 years. As you know, cost of funds have been negligible, and there's been money swishing and swashing around out there. So for those in the capital space, what we're talking about is utilizing some sort of foreign buyer financing. Like, look at foreign buyer financing, because the normal terms are, say, the terms of 30-30, 20-20, so 30% down, 30%, during the manufacture of, 20% when it's ready to ship, and then 20%, once they receive it and inspect it. That's it's used very often. It's kind of was like a win-win type of scenario when you didn't have to worry about inflation and tremendously high interest rates. And remember, interest rates are probably higher where your customer is in more places than not. So if you're selling a piece of equipment for $1 million, even in somewhere like Canada, where the prime interest rate is around 6% or approaching 6%, every month that $100,000 that they have to finance is $500 lost to the buyer. So if you think of 30% down, every month they're paying an additional $1,500 that they probably didn't have to pay previously when interest rates were close to zero.
Mm-hmm.
And when you look at that in totality, it's like almost $20,000 based on that 30-30, 2020 model. And now that's Canada. Take Mexico or another, place where interest rates are maybe double or more, and you can go on a $1 million piece of equipment an additional cost of $50,000 quite easily in just interest. It's 5% increase. All of a sudden, how are you able to compete with what a lot of foreign competitors are doing in offering foreign buyer financing? Two ways to do it, both public and private. Public is Export-Import Bank. They have a program. It is not utilized very much because it almost went away in it did go away in 2015 for a little while. And what that does is it allows the buyer terms of maybe 3 to 7 years to pay for the product. It allows you to get paid when it ships. So again, when you talk about partnership, you're basically getting paid when it ships. You have a small down payment, so that's also key. But the financing of this is being done by a bank who has a guarantee from Exim Bank. You have no recourse to you. So when you look at that from a public side, that's what a lot of foreign competitors are doing with their governments. Those are job programs. Now what's great about the US is we also have private alternatives. We have forfeiting. where it's easier to use than Exim and you don't have to go through all the qualifications. So there's someone like London Forfeiting that offers something very similar, not as, the terms aren't as long, but, they can basically discount milestone payments, no recourse to the seller. So again, private solution, a little easier than Exim Bank, but maybe for a slightly bigger project.
So fundamentally, you're bringing the money with the product, and you're not competing just product only, machine against machine, but you're coming with a 100%, a total package for your buyer.
For the
And what's
buyer.
great, Ken, I was going to say what's great, Ken, is you understand this really well because you have the finance and the selling background. So imagine you're not now competing against a foreigner where they're offering a package and you're just selling a product. Now you can go back to, because both of you have financing packages, you can both go to, okay, let's compete product versus product where we win often.
Sure.
Right.
Terrific.
Okay.
Bruce, I'm afraid we're running out of time. Thank you for, the examples and the anecdotes. It helps. You do an amazing job, as you always do, in explaining complex topics and, rather concisely. And you bring up some really valid points. And, the need for some of these programs, wasn't as relevant a few years ago. And in the really uncertain market right now, I think they're really valuable and a great tool. Thank you for joining us. I hope you'll come back, especially with the economic climate and uncertainty ahead, and really bring some great insights. So thanks for joining us on Talking Trade.
Yeah.
Thank you.
Thanks,
Very much
Bruce.
my pleasure. Thank you.
Talk to
both.
you again.
Yes. Take care.
You've been listening to Talking Trade, sponsored by MMAC's World Trade Association and Michael Best Strategies.